Good morning and welcome to this Wednesday, October 26th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, earnings season certainly has kicked in, and that's not good news for some of the technology names. Last night after the bell, we got some not so great reports from a couple of tech bellwethers. Mr. Softy, Microsoft, MSFT, down over 6.5% this morning. It closed yesterday at 250. Today it's at 234. Then we've got Alphabet, Google, closed yesterday at 104.48, down to 97.79 today, down 6.4%. And then moving over to the semiconductors, Texas Instruments reported last night. 162 was the close after hours, and this morning currently trading at 155.39, which is down a little over 4%. So as you might imagine, that is dragging down futures, especially on the NASDAQ. The QQQ, which tracks the NASDAQ 100, currently down 1.75%. It's not as bad on the S&P and on the Dow. The Spider's down 0.8%, and the Diamond's down about 0.25%. So it's definitely more concentrated on the NASDAQ, and that is going to be some headwinds for the market to try to overcome, especially after the rally we've had. We've got up very close to the 50-day on the S&P, the NASDAQ. We went through it on the Dow. We've had a pretty good rally. This is not going to help, but I'm more interested in what happens today throughout the day than I am at the open. I've talked about that a lot throughout 2022. We've seen a ton of companies that have, or a ton of days where we've seen the action move lower at the open, and then we see rallies throughout the day. It's one of the reasons why those AD lines have stayed up and they've been as strong as they have. So got a few things there to think about. We're going to get into that stuff in just a minute. In fact, we'll go over quite a few earnings reports today, as much time as we have anyway. Try to take a look at some of those earnings reports and the reactions that we're seeing this morning. First, though, I do want to take everyone over to Earnings Beats. Let's go to earningsbeats.com for those of you who are new. And for those of you who have been watching for a while, we have a big event coming up. Just talking about the gap downs and the follow through back to the upside later in the day. That's going to be a key part of what I talk about on Saturday, November 5th. Understanding market manipulation for more profitable trades. I think this is critical to anyone who trades. And I think to some extent, it's pretty important even for those who invest. Certainly, I think you'll find it interesting. And it may change the way you invest. Got a number of different topics that I'm going to talk about on Saturday, but you can click here to register. If you are an Earnings Beats member right now, you don't have to register. We will send you room instructions the day of the event that morning. Just mark your calendars for Saturday, November 5th, 10 a.m. If you are not a member of Earnings Beats, then you'll want to make sure you are registered and save a seat. We will have limited seating capacity, so you want to make sure you save your seat. Be sure to register early. So go ahead and check that out. If you just want to learn more about it, just click on it. It'll show you a lot more about what we're going to be talking about in the session. So I think you'll find it very interesting. And I mean, I'm uncovering a lot of stuff. That's the way I look at it. There are a lot of folks that have no idea of how the stock market works. I've studied it for a long time. I analyze the data. I can provide you a lot of really good information that you might not be aware of. So mark your calendar for Saturday, November 5th. All right. If you don't want to attend, that's fine. That's up to you, but you probably want to check out this free Earnings Beats Digest newsletter. That's all that takes is a name, email address. Hit that subscribe button. No credit card required. Out 3 times a week. Today, I actually wrote a kind of a brief article. This is probably one of the few digest articles that I've written since we've started this free newsletter where I didn't have a chart attached. There was no chart. It was just a couple of numbers along with a couple paragraphs. And basically the numbers were the S&P 500 performance from the close on October 27th, which is tomorrow, by the way, tomorrow's close, through the close on January 18th. The annualized return for that period, let me make sure I get it right here. The annualized return for that period is 21.22%. The annualized return. So basically what you do to get an annualized return, because I get this question from time to time, is you take the average daily return through that period. So I take all of the days on the S&P 500 since 1950 that fall between October 27th and January 18th, get the average daily return, and I multiply times 253, which is basically the number of days that are in a year, number of trading days in a year. So that period, 21.22%. This is since 1950. Once we get beyond January 18th to October 27th, the annualized return is 5.24%. It drops off 16 percentage points. One other really interesting stat about the S&P 500 is that we have closed on January 18th. If you look at the close on January 18th relative to where we closed on the previous October 27th, the S&P 500 has been higher 62 of the last 71 years. That is a very high percentage. And of course, the whole point of this is we are heading into one of the best seasonal periods of the year, starting tomorrow at the close. Now, I know there's many of you who believe, hey, we're not done. This bear market's not over. We're going lower. Maybe we are. And you know what? If we go lower for the next month or two and then come roaring back, and on January 18th, finish above where we were on October 27th, it'll just add to the bullishness. I'm not saying that starting on the 27th, we're going to go up every day. That 62 out of 71 years is simply taking where we are on January 18th, comparing it to October 27th. Are we higher or are we lower? We could be up 1 point on the S&P 500. And that would make it 63 out of 72 years. But I do think that annualized return is very noteworthy. And given the number of days in both periods, it's a representative sample. I'm big into math. I was a statistician. I've always been into statistics, love the class. Trust me, this is a representative sample. This is meaningful information. 21.22% from October 27th to January 18th. That's your annualized return since 1950. This is 72 years worth of data. January 18th to October 27th drops to 5.25%. Anyway, that period starts tomorrow at tomorrow's close. Just want to make sure everyone's aware of it. All right, looking at the action from yesterday, the Dow Jones Industrial Average finished up 337 points. S&P 61, NASDAQ 246, mid caps 58, small caps 26. Looking at sectors, big day for real estate. This has been a group that's been beaten down tremendously, but we were able to come up and close above the 20-day moving average. Big move there yesterday on real estate. Communication services has now rallied all the way back to the 50-day or close to it. The consumer discretionary group through the 20-day, also taking out the high from about a week or so ago, a little over a week ago. So pretty good action on discretionary. Then you got materials up at its 50-day moving average, closing just above, and then utilities testing the 20-day from underneath. The good news is we had a great day yesterday. The bad news is a lot of it is going to be washed away at today's open based on futures. But again, remember, we've had a big move up. The S&P 500 yesterday finished at 38.59, just 9 points away from its 50-day moving average of 38.68. When we printed that positive divergence, lower prices, higher PPO, first thing I said, one of the things I say when I talk about any positive divergence is that all of a sudden, the 20-period moving average, which typically holds as resistance as you're moving down, usually will fail as resistance when you get a positive divergence. Many times, in my experience, we go up to the 50-day, and then we kind of start the game all over again. Once you get the PPO back near the center line and you're at the 50-day moving average, there's no momentum again. By definition, the PPO back near the center line tells you that the difference between whatever two moving averages you're using and the default for the PPO is the 12 and 26 period EMAs. So essentially, when you get to zero, what it's telling you is that your 12 period moving average and your 26 period moving average are identical. That's how you get a zero PPO. So in other words, your short-term moving average and your long-term moving average are the same. There's no momentum. Hopefully that's somewhat clear. Now the Dow's gone through the 50. Does that mean we're going up to new all-time highs? No. I mean, this one's above the 50. This one's at the 50. This one's a little below the 50. To me, it's not about what's above. It's about what's below that I'm concerned about, that I want to watch. And what I mean by that is, do these rising, because now you can see the 20-day moving average starting to rise. On the Dow, you can see that PPO went positive. On all of these major indices, now that we're through the 20-day moving average, do we hold it on a pullback? So I'm not upset that we've got futures down this morning. I mean, it's going to happen. This is not going to be a good earnings season. I can promise you that. Doesn't mean the market will go lower. I think the reason that we went down 25% on the S&P and 35% on the NASDAQ was because of what we saw last night with Microsoft and Texas Instruments and Alphabet. The market prices these things in. So I'm not concerned about the gap down. I'm concerned about whether we hold the 20-day moving average moving forward on a closing basis. If we fail, we go back down below that 20, it opens up the recent lows. If you go down, go below the 20 intraday and you come back up and hold it, and then we can go back up and break out again to new highs, that starts to look more and more like an uptrend. So that's why we want to follow the action going forward. And again, it's not just about today's open. I'm much more concerned about today's close than I am about today's open. All right, let's move on. 10-year Treasury yield. As far as the economic reports go, this morning we had September retail inventories and September wholesale inventories. I'm kind of watching them just because I believe eventually we're going to slow down the economy enough where inventories are going to build. It's going to become more deflationary, and companies are going to have all of a sudden too much inventory, too much supply. I think that's the next stage of this whole pandemic. We've spent a year and a half to 2 years trying to catch up with supply. And now you've got the Fed, which is playing whack-a-mole with our economy. Anything that looks strong, let's just raise rates, just try and knock down anything that looks strong in terms of demand. The Fed wants our economy to go into a recession, or at least to teeter on one if you don't believe we're already in one. That's what the Fed wants. The Fed wants to help kill demand. At the same time, you better watch inventories, companies that are catching up on the supply side, because you might swing too far. And if you swing too far and the demand is down, and then all of a sudden companies have too much supply, what happens? You got to start lowering prices to sell your inventory. Forget about raising prices. So you got to watch that demand supply equation. The Fed's attacking the demand side. I don't think the demand side's the problem. I think the supply side's the problem. So they're literally trying to hammer down demand to get it to the point where it's down closer to supply. That's the way I view what they're doing. Anyhow, the 10-year Treasury yield right now is down another 5.5 basis points. This is pretty significant. I mean, we're down quite a bit. Are we going to hold the 20? We've been, this yield's been continually moving above the 20. If we bounce off the 20 and go to new highs on the 10-year Treasury yield, we're going to have to watch those lows on the S&P 500. I mean, we've come up a lot on the yield. I mean, we're way above where we were at the high back in June. And yet, when we look at the S&P 500, look at where we were back in June and where we are now. So we've seen higher rates, higher yields, but the S&P has weathered it pretty well. And we're now above where we were back in June by a couple hundred points. But if that yield takes back off again and we break back out again, I don't know. That would certainly test the bulls. Now I'm talking about the S&P 500 bulls to see whether or not those lows hold. So I'm viewing this as one of the most critical things to watch. And I usually find the bond market to be smarter than the stock market anyway. They tend to get the signals right more often. So I'd really like to see that be the top and have the 10-year Treasury yield keep moving lower. Again, if it goes back up, all bets are off. We'll see how the market handles it. But that certainly would make for more choppy action, in my opinion. All right, let's go on. Let's look at that S&P 500. So here was that move last 3 days, Friday of last week, and then Monday and Tuesday of this week. Big move up. And this is a week, historically, last 2 days, this is a week that historically is not good. But remember, one of the things going into this week, historically, is that the market tends to be moving higher into options expiration week and sometimes throughout the week. So many times you'll get that weakness in the week following options expiration. So I think a lot of what's created this historical tendency for this week to be bearish is the fact that normally the market goes up during the middle of the month, meaning that we go down at the end of options expiration week and into the week following. So I think that's, a big part of the reason why this is the worst week of the year, but we're not set up that way because we're in one of those unusual periods where we're actually in a cyclical bear market, what I still call a cyclical bear. Others may want to call it secular. I think you got still a lot of work to do to prove that. But a bear market, I think we can all agree on, just the duration and the depth that comes into question. So anyway, we've been rallying this week into a rough week historically. Today, we're going to gap back down. We'll see what happens the rest of today and tomorrow. But then it's like the market flips a switch. Bearish to bullish. Cold water to hot water. Unless you view hot water as being bearish, then it's hot water to cold water, whatever. But it's almost like we flip a switch. We have the worst week of the year historically. And then all of a sudden, October 28th through November 5th is one of the best weeks. Actually, I would say it is the best week. So we go from the worst week of the year to the best week to 10 days, back to back. So there are issues on both sides. The bulls have to contend with the rates and what happens with the rates and the inflation and the Fed, possible recession. And the bears really have to deal with history, the historical tendencies of the upcoming period, but also history of bear markets. Most bear markets, when they end, and most of them end at about this level, you drop 25%, the overwhelming number of bear markets are pretty much ending at that point. We have a few that go deeper. We'll see whether or not this is one of them. I don't believe it is. NASDAQ 100 also rallying back up. If I go to an hourly chart, could have done this on the S&P as well. You can see this move up just past 11,600. Actually, let's stretch this out a couple months, 3 months. But you can see this rally failed. You also had a couple of other rallies in the 11.5, 11.6 range that failed. We turned up, failed, turned up here, failed, here, failed, here, failed. Now we're back up in here just a little bit higher. But look at that prior low before we broke down. Let's look at this right here. See this low? Went back up, and then we broke down. And since then, we have not gotten back through this level, which is about 11,750. Now keep that 11,750 in mind. And let's go back to the daily, because the 50-day moving average is at 11,879 and dropping. So we've got that price resistance right in here where this breakdown occurred at 11,750. We've got this breakdown on the daily chart that occurred at 12,000, and we've got the 50-day between them at 11,879. It's a lot of overhead resistance for the NASDAQ to move through. And if we keep getting earnings reports like we got last night, it's going to make it particularly challenging, which in my book makes it all the more meaningful if we get through. If we can get all this bad news and the market goes up, that's a good sign. It tells us that bad news has already been priced in. So again, today we know we're going to gap down. What do we do afterwards? That's going to be really important. All right. I want to talk some about earnings because a lot of earnings came out last night. Let's see what they're doing today, this morning. So I'm going to go over, let's take a look at Microsoft. As I mentioned, I'm just going to go down through some of the big names, some of the big market cap names. Microsoft still dropping, down 7.3% today, $18 on its chart, back to 232. Still above the recent low, but that's a big drop on Microsoft. My guess is that it's going to hold this 225 area. So I like Microsoft on a pullback. I have not yet had an opportunity to go back and look at all of the numbers, the revenues, earnings, to see whether or not they beat on both levels. I know, I think it was Alphabet, Google that warned. Haven't really looked at all those details yet, but Google down 6.5%, $97. Again, above the recent lows, but that's a pretty big drop back down to that level. Texas Instruments down 4.6%, 154. That's going to be down in here, still well above the recent lows, kind of in the middle of no man's land. I'm not sure it's going to be below the 20-day, but in the middle of the range. There's probably wouldn't be doing anything with that one. I'd have to kind of wait and see which way it goes. Visa reported last night after the bell. Here we have a positive, up 1.22%, and we closed over the 50 yesterday. So we're at least starting to turn the corner, it appears, on Visa. I would just be watching that rising 20-day, which has been holding on these pullbacks. Make sure that continues to hold. In the insurance area, Chubb down 4.3%, $8. They reported yesterday. So 192.60 back near the 20-day. This is a good area of the market. If they beat top and bottom line, this would be a stock. Maybe I would expect to bounce off that 20-day. Have a pretty good day after the open. We'll see. There's just been a lot of rotation into that area of the market, which is why I think this could be an opportunity. We might see more accumulation. How about Chipotle in the restaurant area? CMG down $24, but it's a big dollar stock. So down 1.5%, 1560. Still looks like it's going to open around that 20-day, maybe slightly above it. We'll see whether or not that holds. Enphase Energy up 16. So this one's up 6%. So that's nice. See one going the other direction. But we had pulled back quite a bit. We had a huge run in renewables. Enphase Energy was up to 320. It pulled all the way back, by the way, to this gap support area right here, turning back up. And now today at 282. I just think it's sideways in the middle of this range. So you still got a lot of room potentially to the upside, but you have a lot to the downside as well. So a lot of risk, in my opinion, taking a position on either side of that one. Let's see. How about Spotify? Got about 5 more minutes before the market opens. Spotify down 5%. So again, big rally to the 50-day, but now we're back down close to the 20-day. Does that hold? IEX was one that I really liked heading into its earnings report. It's not showing any kind of action, but I just like the configuration. Looks to me like we had a little bit of a, I don't know, maybe a little channel that we broke out of yesterday. But overall, we had broken out above this double top, and we had been holding that on a pullback. So on a relative basis, IEX has been very strong. It's an industrial machinery company, so it's in the industrials, which has been a strong area. If it does gap down, especially anywhere back down near that 20-day, I'd be interested in that one. Let's see, Boston Properties, BXP. Just checking this out because real estate's been so weak. BXP down $1.59, 2%. Look at this, not good action here. Wouldn't have expected a whole lot. Juniper Networks, JNPR, up 2.7%, up near 30. Got some overhead resistance here just above 30, so watch that. But looking pretty good there. FFIV, this is F5 Networks, down 7.6%, back down to 141. So it is also looking to move back down near recent lows. Manhattan Associates, this is a software company. Last earnings had the huge move up and kept moving higher. What a difference 3 months makes. Stock comes all the way back down and now is looking to open back down at 124 and change. Very close to that gap support. Watch 121, 122. That could be an area where the stock bounces off of. All right, those were all from last night. Let's do this morning, some of the big market cap from this morning. Thermo Fisher, TMO, down 2.8%, down $14. Bristol Myers, BMY reported they're down about 0.5%, not too bad. ADP, automatic data processing, up 7. So pretty nice move there, nice breakout on ADP. Boeing, down $1. Maybe the worst is finally over for Boeing. We made the move up through the 50. Watch that rising 20. We could be in a nice uptrend starting here on Boeing. That 20-day, the closer we get to there, the better the reward to risk entry. Waste Management up $1.34, almost a 1% move there. This group's been pretty strong. That's the waste and disposal area. General Dynamics in the defense group, which has been very strong, down $1, 244, but we just recently broke out. I think any weakness here, especially getting down anywhere close to that 20-day, 236 to 240 up in this area, I would think that wouldn't be a bad area to consider. CME Group up 1.6%. You can kind of see what's going on as I pull up all these companies. Industrials, financials tend to be doing pretty well. Tech related, not so much. And that's what the market's been telling us. When you look at relative strength right now, money's been rotating out of those tech areas, out of discretionary and into industrials and financials. And now we're seeing why. Industrials and financials, their numbers aren't that bad. Let's see, Railroad, NSC, up a little bit, not much, but something. KHC, Kraft Heinz, this is in the food products, up 2.25%. So it's not all bad news. It's mostly around that technology area. Hess, we'll do 3 more. It's 9.29. We'll do 3 more and wrap this up. Hess up 2.2%. This is a really strong stock. You could get a gap up and then possibly a move back down. If it does come back down, again, watch that rising 20-day. I like it there. So 2 more. How about Hilton? HLT in the hotel area, up 1% this morning, 132. It's at this double top. It needs to clear. Moving through 140 would be very bullish. That also gets you above that 200-day moving average. And let's see, 1 more. Let's find a good one down here somewhere. How about Garmin? What has Garmin been up to? Well, Doesn't show anything. I'll pick one more. Let's go with a trucker. ODFL. This is Old Dominion. Still not giving me any updates there. Maybe, did we open? Oh, we opened. So let's see where ODFL opened. Okay, pretty nice move up there, up $11 to 285. So nice move there for a trucker. That should help the transports. Why don't we look at the transports, by the way? Last thing we'll look at here. And the transports are showing right now up 175. Is that today? That is today. Okay. Watch 13,500. That's your gap resistance. So getting to the PPO center line, transport's making the move through the 50. I think the 13,500 is going to be your key resistance here to the downside. Got a lot of support now at around 13,000. And then that rising 20-day coming up from underneath 12,865. So that's your range, 13,500 to the upside, and then about 12,865 to 13,000 to the downside. If transports make a move to the upside, I think that's a really good sign. Not because our economy is strong, but because the stock market looks ahead. We want to see transport starting to lead. So getting some good action this week so far, but we need more than just a temporary move. Let's hold key support and let's keep moving to the upside. This will be, along with the 10-year treasury yield, this is going to be another key chart to watch. All right, let's go to the dashboard, get a quick update on the overall market. Yeah, the NASDAQ down 2%. Look at the Dow, actually up today. The VIX down with the S&P being down. Kind of crazy start to the day. Small caps up, mid caps up. This is going to be the key, though. Does the NASDAQ bounce back later today? With yields down, 10-year treasury yield, where's that right now? It's down 6 basis points. Don't be shocked if this is just a little bit of morning weakness and we see a big rally back in some of these NASDAQ companies later today. Just a feeling, but if the yield's going down, that will help this group on a relative basis. So it could just be an initial shock, and then we'll see whether or not they hold. Microsoft, well, down to 230. Lowest close is 225. So we quickly are moving back down toward that. Anyhow, that's all I got for today. Appreciate you tuning in. I'll be back tomorrow over at Stock Charts TV for your next Trading Places live episode. So at 9 a.m. tomorrow, just click on Stock Charts TV and you'll be able to bring the show up. Have a great day, everybody. And remember, November 5th, big event. Make sure you're registered if you're not already an Earnings Beats member. Have a great day. Happy trading.